Do you ever wonder where all your business's money is really going? Even if your profit and loss is indicating that things are going okay, you might have noticed that at certain times your bank balance is telling a completely different story. This is where the cash flow statement comes in. It's basically the financial statement that helps us understand how cash is moving through and cycling through the company. Guys, my name is Nate Littlewood, and in this video, I'm going to be breaking down the cash flow statement. Whether you're just starting off an e-commerce business or you're scaling a CPG brand, understanding cash and cash flow is critical to the financial health of your company. And make sure you stick around to the end because I've put together a free resource and guide, which is basically a cheat sheet to understanding your cash flow statement. You'll be able to grab a copy of that towards the end. So in a previous video, I'll link that up here, we talked about the profit and loss statement, and that's arguably the most important financial statement, but it is the cash flow statement that is more likely to tell us if the business is basically going to run out of cash and run into some serious health problems. So, as the saying goes, and I'm sure you've heard this before, but cash is king. Cash is literally the lifeblood of any company. Cash is the stuff that you receive from your customers. It's the stuff that you pay your vendors and suppliers with, and not to mention also your employees. And, it's critical to keeping a business alive. Now, a business can, theoretically, for a period of time, operate without profit, but it can never operate without cash. Without cash, things are going to grind to a halt. So, what is the cash flow statement? Well, the cash flow statement is one of three key financial statements, along with the profit and loss and balance sheet. And basically what it focuses on is the cash that's coming into and out of the business. So the cash flow statement basically helps us avoid surprises, and it is the basis of an activity or function that I do a bit of as a CFO, which is basically cash flow forecasting, which is the exercise of determining whether or not we have enough cash in the business to cover the expenses and, other investments that the business might want to make. So the cash flow statement is divided into three main sections. The first, and probably the most important one, is the operating cash flow. As the name suggests, the operating cash flows really tell us about the day-to-day, operations or the core function of the business. So what you're going to find in the operating cash flow section is you'll find receipts or payments from customers, your revenue. You'll also find all of your payments to vendors and suppliers, payments for marketing fees and that sort of stuff. And obviously what we're looking for here is the operating cash flow to be a positive number. If that's the case, it means that the business is able to financially sustain and support itself through its own core operating activities. Now, don't freak out if your operating cash flow is negative occasionally. That's totally normal. What's going to happen at certain times a year, particularly for very seasonal businesses, which is fairly common in e-commerce, is that it might need to invest a lot in inventory, for example, in the late summer or fall, getting ready for the Christmas holidays. So what can happen at certain times of year is the business is actually sending out more cash for things like inventory than what it is bringing in revenue. Therefore, we can have negative operating cash flow for a period, but the operators of that business are presumably doing it on the expectation that at some point in the not too distant future, that's going to turn around and that the incoming cash, i.e. from revenue, will exceed the outgoing cash, and therefore we'll be able to pay for all of that inventory that we accumulated. So the next section on the cash flow statement is going to be our investing cash flow. And this is where you will find the cash that's being invested in longer term opportunities. For an e-commerce or CPG company, this might include things like plant, property, equipment, potentially real estate, that sort of thing. We may also find stuff like intellectual property or patents if they are somehow somehow being, bought or sold, they would also be in the investing cash flow section. Basically, where you will find things that the company is investing in for a long-term view, and it's going to help make running the company more efficient in some way. Now, within e-com and CPG businesses, it's unusual to find large amounts of investing cash flow. The reason for this is that business model of most of these companies, especially when they're earlier on, is that they won't actually invest in their own plant and equipment. Instead, what they're essentially doing is borrowing the equipment of someone else by working with a co-packer or manufacturer. So when you pay someone else to manufacture a product for you, part of what you're paying for there is to rent or borrow their plant, equipment, machinery, warehouse, like whatever else they have purchased to produce the product for you. Now, as the companies grow and get larger, it would be more and more common to see them want to bring those assets in-house. And when a company does acquire its own property, plant, or equipment, then you're obviously going to see that on the investing cash flow section. The final section of the cash flow statement is the financing cash flows. And this is basically where you will find things like monies coming in from investors. It's dividends, although they're pretty uncommon in startups. And you'd also find the proceeds of and repayments of any loans that the company might have received. So this is money that's basically being put into or out of the company to usually assist its growth in some way, but it is not money that has been generated through doing the core activities or function of the company, i.e. this is not being generated by, manufacturing and selling product, okay? This is someone else putting money into or out of the company. Okay, so let's talk about some of the things that we can learn from a cash flow statement. The first metric is going to be the net cash flow, right? Which is basically the sum of these three different types of cash flow that we talked about. Obviously, it's helpful if the net cash flow is positive. And if your net cash flow is indeed a positive number, what that means is that we would expect the cash in the bank to be increasing. So if we started with $200, we had net cash flows of $100, then I would expect to see $300 in the bank at the end of that period. Another fairly important metric here is the free cash flow, which is basically the operating cash flow less the investing cash flow. This is a really, really important metric because it tells us whether or not the company is generating enough cash from the operations of the business to cover the ongoing cost of kind of maintaining and taking care of the upkeep of that business, i.e., the investment in plant and equipment. So as an example, if a business was generating $200 of operating cash flow every period, but every month we had to invest $300 to maintain the factory, the warehouse, buy a new plant, buy a new truck, whatever, then we've actually lost $100 a month in running that business. And that's clearly not a sustainable situation. The other metric that's pretty common, especially in startups, is the cash burn rate. So basically what we're calculating here is how quickly is the company burning through cash. And what we do is then compare that to their current cash balance. And that gives us a metric known as runway, which is commonly measured in months or ideally years. Okay, let's talk about some of the easiest ways to improve the cash flow of your business. And I've got three simple ideas here. Number one is to basically improve the speed or the rate at which you collect payments from customers. If you're a merchant selling on Shopify, an e-commerce guy, there's probably not a whole lot you can do about this because Shopify tends to pay you out, within a few days of getting the order. But if you have a large retail presence, in other words, you're selling to grocery stores, for example, you might be able to offer incentives for early payment. And obviously, the quicker you can get paid for the delivering your product or service, the healthier your cash flow is generally likely to be. The next thing you could potentially do is delay your outgoing payments, for example, by negotiating better payment terms with your suppliers, because the slower or the more of a delay there is in you sending money out of the company, the better off your cash and cash flow situation is likely to be. The third option that you have is basically being strategic about how you manage inventory. For most e-commerce and CPG companies, inventory and product is the single largest expense that they have. And you want to be really, really smart smart about how you invest in inventory. Sometimes come across founders who are sitting on up to a year's worth of inventory. They selling, maybe $100,000 a month, but they've got $1.2 million worth of inventory. That basically means that you have cash parked on the factory floor, not doing anything for 12 months at a time. That can get really, really expensive, not just because of the storage costs, debt that you're going to have to pay for that. You're just limiting what you can do with your cash when you have locked up in inventory. Now, it's not the focus of today's video, but since we're here talking about cash flows, I did want to mention the 13-week cash flow statement. Now, the normal cash flow statement, when you hear people referring to it, generally what they're going to be referring to is a monthly statement. So October, November, December would each have their own columns. In a 13-week cash flow statement, we basically increase the resolution. And instead of a month, the time period that we're using is 7 days. And we do that for 13 weeks into the future, which is roughly a quarter. Why a quarter, 13 weeks? Honestly, it's kind of arbitrary number. And sometimes I do flex that up or down, depending on the needs of the company. But there's a couple of reasons why 13-week cash flow forecasting in particular is a really, really helpful exercise. Number one, if it's a distressed company without a lot of cash. And if you're needing to be very, very precise with timing and careful about when things are coming into and out of the bank account, then there is no better tool to manage that than a 13-week cash flow statement. The other scenario where it becomes really, really handy is when you have very seasonal businesses that are investing in large amounts of inventory, for example, going into the holidays. It's often a really, really tight juggling act to line up these inventory purchases and payments to suppliers with, for example, the Black Friday shopping holiday period, right? You've got very, very large amount of cash coming into and out of the business for inventory and revenues, and things are changing quite quickly. And in situations like this, the 13-week cash flow statement is an incredibly useful tool to be using. Okay, so let's talk about some of the common mistakes that I see founders making with their cash flow statement. The number one is confusing cash flow with profitability. They are not the same thing. A profitable business can still run out of cash, and without cash, things just fall apart, and it's really, really hard to continue to run the business. So cash flow forecasting is a separate function and a separate activity to profit forecasting. Both important for different reasons, but they are not the same thing. The next mistake is people just neglecting to forecast their cash flows. This makes you really, really vulnerable to shocks and surprises. You might run into problems with being unable to run payroll or unable to pay a supplier, and so they refuse to ship product to you. So businesses that fail to model their cash flows are far more likely to have these unpleasant operating surprises. So the third big mistake that I see founders make, particularly the earlier stage folks, is that they ignore or overlook the financing cash flows, which is basically the cost of their debt and balance sheet, right? So most founders have got a pretty good handle on what the product costs to produce and, how much they get paid for that product. But a lot of them overlook how much they're paying in interest on the inventory that they needed in order to be able to produce and sell that product. And it is not uncommon at all for those interest costs to completely obliterate and chew up all of the operating margin or operating cash flow that the business would have otherwise generated. So hopefully I've convinced you in this video that understanding your cash and cash flow statement is key to building a financially sustainable business. So the cash flow statement doesn't just track cash. It gives you the insights that you need to make smarter decisions, plan for the future, and align your cash flow with the overall business growth strategies. Okay, so if you are ready to take control of your business's cash flow statement, then head down to the link below where I've got a free guide. You can download this, basically a cheat sheet on how to interpret and understand the cash flow statement for your company. And if you're interested in more content on financial literacy and how to grow a profitable e-commerce or CPG business, make sure you give us a like, subscribe, hit that notification bell, and I will catch you next time.